everyone and welcome to CT Connect. When we talk about planning for the future, we all focus on growing our income, but how many of us actually think about protecting that income? I'm joined today by Joey Gregory from Share NZ, an expert in personal insurances. Joey, when you're talking to your clients, you've got some great ways of helping them understand why income protection is so important. Can you share some of that with us today?
Yeah, so income protection is a super important product to have in place, especially if you or your family rely on that income. There's many different products in the income protection suite, so it is worth talking with a financial advisor to ensure what you've got in place is right for you and your situation.
And one area that I've heard you talk about before is the money tree. Can you explain that concept?
Yeah, so I often pose the question to my clients whether they insure their major assets, and all of them, of course, say yes, we insure our house, our car, and our contents, but they don't insure the money tree they have in the backyard, which is themselves and their ability to earn that income that pays for those assets.
Yeah, that's a great analogy. Another question I often get is, well, doesn't ACC cover me? So what would you say to that?
Yeah, we're really lucky in New Zealand to have ACC, and it is a great product. However, it's not comprehensive, and it doesn't cover things like critical illnesses or things that would be classed as wear and tear. And often people are caught out by that and sometimes surprised that ACC doesn't cover illnesses. This is where an income protection policy comes into its own, where it does cover those major illnesses that ACC wouldn't cover.
And another comment we often get is that insurance premiums are constantly rising and it causes a lot of frustration. Can you tell us about the concept of a level term policy?
Yeah, so a level term premium is a product that has fixed term premiums, so you lock in the level of cover that you want and it has a fixed price. The standard premium structure is a rate for age or a yearly renewable term policy. This starts slightly lower, but it increases each year with age. It's often called a stepped product. As you get older and closer to the statistical death age, those premiums really start to skyrocket. That's where having a level term premium in place creates a lot more certainty and surety around what you're paying. We can often put in place a hybrid structure where we place a foundation of level term cover and create the house or build the house with the rate for age premium, which gives you the full amount of coverage you require. As your liabilities decrease and the need for the cover reduces, we can remove or lower the rate for age and step premiums and leave you with that foundation of cover long term.
Sounds great. If our discussions today have prompted you to think, maybe I should be putting in place some personal insurance, or actually I could do with a review of what I've got in place, just flick me a message and I'll connect you with Joey Gregory from Share NZ. We're here to help.